Hi everyone, welcome to Macro Meets Business Insights from Wharton and Beyond, Penn IBEC's brand new podcast meant to analyze macroeconomic trends and their business applications. I'm your host, Diego Ordonez, and I'm also the Chair of Economic Analysis here at Penn IBEC. Today we're going to discuss the politicization of the Fed, their recent rate cuts, and potential impacts on the stock market. We'll be covering articles from the Wall Street Journal, Bloomberg, and Reuters, and also have a discussion with Renan Muta, a finance PhD student at the Wharton School. Hi everyone. So I'm joined by Renan Muta, a recent graduate at the University of Pennsylvania who majored in mathematical economics. He was awarded the Rose Undergraduate Research Award and the Bernard Schanbaum Prize for Excellence in Economics. He also had a position as a macro research analyst at Goldman Sachs and is now completing his PhD in finance at the Wharton School. How are you, Renan?
I'm good. Thank you for having me, Diego.
Great. Thanks so much for coming. So to get started, I guess for background information for the viewers, I'll ask you from an economist perspective, like yourself, what does it mean for the Fed to be independent?
Yeah, of course. So when we as economists think about the Federal Reserve being independent, we usually think about the Monetary Policy Committee, so the FOMC in the case of the US being independent, in the sense that when they make their policy rate decisions, they are following the most technical view, having an economic rationale behind supporting their decision, uh, completely insulated from any political incentives that may arise. And we usually secure that across the world with not allowing presidents to fire any monetary policy director based on their monetary policy decisions. And the reason why is that in the US, for instance, we have a clear mandate in which the Federal Reserve needs to achieve price stability and maximum sustainable unemployment, while the president, on the other hand, may most focus on short-term gains. In the sense that, just to give an example, usually presidents, and this is not something, this is presidents all around the world, want lower rates. And suppose that we are in a case in which the economy maybe is overheated and is generating some inflation. The Federal Reserve or the central bank should increase rates and in order to reduce inflation, and probably this is gonna come at some economic cost. Of course, politicians don't want that. They want to secure votes. They have short-term political incentives to do so. So mostly, mostly politicians would like to have lower rates, while the central bank needs to be conscious about this trade-off between economic activity and inflation.
Great. So yeah, that that was a quick summary on the independence. So why do you think this independence, specifically in the case of the United States, is so important to maintain the dollar's stance as a global currency?
Independences are important for central banks, no matter if they are in the US or if they are in any other country, especially because monetary policy mostly works for expectations. And if you think that any central bank is took over or is not making decisions based on like good economic arguments, then it probably be uh, could hurt the economy in the medium to the long run. In the case of the US, and when you think about the dollar as a reserve currency, we think about this dollar exceptionalism in which the entire world thinks that the US dollar, and in this case the US government bonds, the treasuries, are a risk-free asset. What does it mean to be a risk-free asset? It means that they expect the US government not to default on you. So for instance, if I lend you some money and you expect me to repay in 1 year, I'd like you to repay me the money. But of course, after 1 year, you can say, "Oh, I'm gonna default on you. I'm not gonna repay you," and then probably we're gonna go with some like litigation over how to proceed next. If I believe that you're gonna not repay me, probably I'm gonna charge you a higher rate. So that's basically what happens. In the case of the US, is they expect that the US government will never say they're not going to repay me. But there is a difference between governments versus corporations or households. Governments can do this soft default in which they can basically increase inflation, and then in this sense, basically they are kind of defaulting on you. Just to give this other example, suppose that I lend you $100. Well, now you increase inflation to 10%. Well, I still get the $100 next period, But now these $100 are really worth $90 or like 90 real goods for me. So this is some type of like of soft default that some countries try to do, and that's why the Federal Reserve being independent is important, because with an independent central bank, we kind of like isolate this idea that governments could choose their inflation rate and could choose to use this soft default, and therefore investors are not worried about any type of risk of default, especially on the U.S. government. So with the Fed being not independent, then it could be that maybe they're going to tolerate higher levels of inflation, and of course this is going to be a concern for international investors holding this government debt.
Great. Yeah, that's actually a perfect segue to what I wanted to talk about next. So, as I'm sure you know, recently the Fed decided to cut rates, and there is scrutiny about that decision, mainly because of two recent events. So, Stephen Miran was recently confirmed to the Fed board, after, as mentioned in the Wall Street Journal, a little bit of a sort of back alley entrance to the Fed board. Usually they would be confirmed by the Fed chair, which would be Jerome Powell, but it was actually confirmed by a Georgia judge. So, what do you think, based on his conservative background, his relationships to Trump, and his economic philosophy, where do you think his opinion could affect the board?
Yeah, as you said, like he was part of the administration. He was the chair of the Council of Economic Advisors for the president, and basically they appointed him in a rush in order for him to be part of the last FOMC meeting in which the Fed decided to cut by 25 basis points, with his vote being for a larger cut of 50 basis points. Well, I personally think that no matter what's the case, when presidents put people very close to them into their central banks, it's a bad signal. It's even a worse signal when he chose not to resign from his position but take only a leave while being at the Fed. So this is really shows that he still have ties with the administration. But on the other hand, we also need to account that he's one vote of 12 voting FOMC voting members, and of course that if he managed to produce a good economic rationale for why we should reduce rates that aggressively and convince other members, that it could shape policy. But on the other hand, if he has no argument and just being, I want the rates to being lower, well, market participants probably are not going to buy. Other FOMC voting members are also not going to buy this this reasoning, and in the end they're just going to discount. So if before I expected the Fed to act unanimously, now I know that there is a guy that is very dovish, and now I expect one guy always to dissent. So probably it doesn't have a good direction. Like him being there doesn't mean that the Federal Reserve maybe their decisions are going to be more dovish per se. There are some research that show that when there is this agreement among members, it usually is a good predictor of their future policy rate decisions. But I think that this always comes in the realm in which people are making reasonable economic arguments to support their decisions. And of course, the central banks usually like to come as a united front, so they tend to accommodate for the minority views. But in this case, which is so extraordinary, I think that probably like it shouldn't matter that much.
Great. So that's actually a very interesting part. I mean, obviously, since a lot of Fed board nominations come from the executive branch, this isn't something that I think is completely new. I feel like it has happened in the past. Presidents nominating members to the board that are typically aligned with their interests. But also, President Trump has been trying to fire Fed Governor Lisa Cook for, I think, mortgage misrepresentation or something like that. How do you think this kind of political firing or involvement in the Fed board could impact the public's view on the Fed?
Sure, yeah, not entering the matter of if what she did or not was wrong or right. I have no say. Only as an economist, I can basically say that usually presidents trying to fire central banks is a big trying undermining of independence of the central bank. And even if it doesn't go through like for the Supreme Court, I think it also has an effect in the sense that if I'm someone making the monetary policy director, I would like to be completely autonomous in my decision. And now if I think that there is a risk that I may lose my job, of course it could shape my decision. More than that is what the market perceives as as what is happening right now. If the market perceives that the Fed's independence is being attacked, probably, as we discussed earlier, they're gonna require a higher rate to hold, for instance, the government bonds. So the Federal Reserves control the short-term end of the curve. But in the end, what really matters is the long-term end. And this is not decided by the Fed. This is decided by market participants. And a good way of like ensuring that these long-term yields are like stable, it's through thinking that the Federal Reserve is going to do a good job. So this could clearly backfire in the sense that, for instance, if the Fed wanted to cut, and probably they would cut, they would cut, the market would think that is a credible cut, and therefore probably is going to stimulate the economy. However, now that we think that there is a threat to independence, well, we could, maybe the market thinks, oh, maybe they are influenced by political incentives, and therefore they even require a higher rate to be compensated to holding this risk. And in that sense, maybe it's not going to be that effective like this cut to stimulate the economy. So this could really backfire. And that's why there's a good, when you think about independence, it's something that presidents should, I mean, they always try to lower rates, but not that explicitly, because of course this would affect market participants' expectations, and this could probably backfire on the original goal.
Great. Yeah, so I mean, historically, I think we have seen this in the Nixon administration in the 70s. He pushed for the Fed to cut rates, and the Fed did follow suit. That caused inflation and, some capital flight, I believe. Obviously, the dollar weakened a lot. And obviously, post World War II, the government pressured the Fed to peg rates in order to keep a certain interest rate, target interest rate for the viewers. And that also led to inflationary pressures and weakness of the dollar. So do you think we could see weakness of the dollar? Bloomberg recently reported a 3-year low ahead of the decision. And post-decision, I can only imagine how it is.
Yes, I think that it's already showing up in the data. If we look at the dollar returns for 2025, is one of the weakest dollar returns in history, even though we have the stock market and the bond market still high up. And the reason why is that, and I saw an interesting chart which shows that international ETFs, they still want to benefit from being exposed to US companies. So they still want, for instance, to invest in Nvidia, in the Silicon Valley stocks. But at the same time, they don't want to bear the dollar risk. So usually before what happens is that these ETFs would enter the US unhedged against the dollar. And why is that? Because in the case that a major crisis happened in which the S&P would tank, probably the dollar would appreciate after that, which would mitigate which would mitigate this risk. Now, after what is going on, we see that in times in which the world is in big stress, the U.S. dollar didn't appreciate, so people didn't put their money back in the U.S. as a safe haven, and therefore now these ETFs are using hedged positions. So they want to be exposed to US stock, but at the same time, they don't want to hold any dollar risk. And therefore, like they are not basically buying dollars. So this is a reason, like when we think about this US exceptionalism, we think because it has been for so long, it's the US is this dollar reserve currency, but these things change. And of course, it's hard to change, but it could change. So in the 19th century, it was the British sterling, which was the dominant currency in the world. And if of course, after the war, the dollar became the prevalent currency. So yeah, I think that the international community is already kind of aware, and it's kind of like if before they thought that dollar was this risk-free asset, maybe now they're accounting for some risk.
Hmm. Interesting. So do you think there should be reason to concern or sorry, to be concerned about capital flight or people starting to move their assets out of the US?
Um, it's a hard question in the sense that the US still seems to be an economy with good investment opportunities. So, and then of course, when you think about capital flights, then you need to think, okay, so if I'm not investing, for instance, in the Silicon Valley and in the tech companies, where should I invest and get like similar returns, right? So it could be that although the US is not looking that good in terms of like institutions and in terms of like bearing this exceptionalism, it's still, even though accounting for this risk could still be good for investors to allocate their portfolios here.
Interesting. So I wanted to talk a little bit more about the like core economic side of this. So President Trump has recently criticized low job numbers. The U.S. has added the lowest job numbers it has in many years, I believe. And lower job numbers obviously indicate a slowing economy. But he has pushed for rate cuts to boost economic activity. Obviously, this would make sense. A slowing economy, you want to cut rates to boost the economy. But however, his recent tariffs have increased inflation. So it's a little bit contradictory here. So I was wanting to ask you what you think the Fed should focus on, what their priority should be to control the inflationary effect from these tariffs or to help boost the economy from the lowering job numbers.
Yes, I think that's a very hard question because of course this when we are in this I don't want to say stagflation, but when you are in the scenarios in which you have both high inflation and low economic activity, it's always hard for central bankers to choose what is the right balance among these two things. Uh, I think that something that should be, in my personal view, I think that inflation is a problem in which it's very hard to address, is very persistent over time, and it spillovers very fast across sectors. And we could saw that when there were all these arguments that the inflation was going to be transient, would be short-lived, and it was just used cars, and in the end, it spread over for the entire economy and became very well persistent. It's very hard to think what are the effects right now of tariffs. Economically, we would expect these tariffs to be inflationary, even though we couldn't see that still picking up that fast in the numbers, and that could just be from the fact that this business knowing that tariffs are gonna occur, they probably like build inventories ahead, and probably these effects could be more delayed. So it's something that the Fed needs to take into account when when doing their monetary policy decisions. At the same time, it could be that the tariffs is just a one-time increase. And then if you think about inflation as the difference in price levels, of course the price level increases after that, but it could be just a one-time shock. And then they could focus more on the on lowering the rates to the economic to help the economic conditions. But I think that in the end of the day, of course, we focus a lot on what the Fed will do and should do, but in the end, what really matters is the long-term end of the curve. So it really matters that market participants are on board of whatever Fed decision it is. It also a big concern that most economists have right now is the fiscal side of the US. It made sense to have these large fiscal deficits and this big government debt when you have lower rates and high growth, maybe with an environment of higher rates, as we discussed before, maybe because the US is losing this exceptionalism, or maybe because in the US we're not going to be able to grow sustainably for like large periods of time as it managed to do before. These fiscal considerations came into account. And of course, when you think about it as an economist perspective, what the Fed could do to help adjust that is also like to increase the rates to in order for the government to discipline itself. So I think that it's a hard question, and there are good economists thinking about that. Policymakers, it's this trade-off from what the Fed signaling from the last meeting. Like they managed to relieve, they wanted to relieve the high rates for about 25 basis points, but some of the FOMC members don't expect any more cuts in this year. So you could see in the committee, and you could see from the summary of economic projections. This big dispersion on beliefs. And this is exactly comes along with your question, like what should we do? So it's a hard question.
Right, so it's kind of like a wait and see situation to sort of see how inflation plays out to see how the decision should be made.
Yes, Jerome Powell has highlighted in his Jackson Hole speech that it's going to be data driven, the decision. The problem, of course, is when we look at this employment, this economic data, it comes always with revisions. So I think that the revisions showing that the economy was actually weaker than we previously expected could could like make the argument that maybe the Fed was taking these decisions into with the data taking into account that the economy was stronger. Now that we actually the economy was weaker than we should, and maybe there is a policy mistake. But the only thing that the Fed could do is to focus on the data, and basically I think that's the strategy that they are looking.
Great. So to wrap up, I guess for the viewers, why should the average American care about a politicized Fed, about how it could impact their pocket?
Yes, I think that in the US, well, the everybody cares a lot about the Fed, and maybe they shouldn't. I mean, it's bad for me to say that, especially because I'm an economist that focus a lot of monetary policy decisions. But as we discussed before, the Fed controls the short end of the curve, and most of the things that would affect Americans happens in the long term end. So if you think about mortgage rates, for instance, they are set as a benchmark with the long term yields parts of the yield curve. So it matters this politicized Fed because it could really affect the market participants' expectations, and this could really have an effect in the effectiveness of monetary policy. For instance, as we discussed before, they wanted to cut rates to stimulate the economy, which would be good for the average American, right? Now with like this perception that maybe the Fed is politicized, this even this 25 bp cut will not be enough. So more than the decision, it's how it is conveyed and what market participants expect.
Great. Well, thank you so much, Renan, for taking the time out of your day to join me on this podcast. I really appreciate your input, and we'll definitely be in touch in the future to discuss this a bit further.
Thank you. It was my pleasure, Diego.
So, as we learned in today's conversation, a politicized Fed could induce volatile markets and weaken the dollar. This could lead investors to rethink their confidence in the US economy and could potentially be dangerous to the US economic power on the global stage. As we continue to track these developments, one thing is clear. The health and credibility of the Fed is not only important to policymakers, but is also a crucial aspect of investor strategies. Thank you very much for watching, and we'll catch you next month.